Forex for travel. In the event that you've at any point ventured to another country, you will have needed to exchange your home country's currency to that of the nation you are visiting. Depending on the size of the transaction, this can be done at your local travel agent, the airport, more recently done online, or with the invention of fintech banks. This can be done within your bank account and either spent by using your debit or credit card in the traditional way in the country you're visiting, or withdrawn when you arrive. So without actually knowing it, you have in some way already participated in the Forex market. By visiting another country, upon returning to your home country and trying to change back the leftover capital, you will have realised the exchange rates have changed. That is partly due to the retailer of this transaction preys on the fact that the currency isn't worth much to you in your home country as you cannot spend it. But regardless of which, the currency exchange rate will have moved in one given direction, better or worse. We all know it is always worse when selling the currency back to the retailer. But for the sake of this example, we are realising that there has been a noticeable difference in the price that you bought and the price in which you sold back the currency. You can also use Forex in your business. Let's imagine you are the CEO of a large multinational business, such as a car manufacturer. The country in which the car is manufactured is the United Kingdom, but you wish to purchase exhaust parts from a manufacturer in Europe. The clear issue here is that you are trading in or being paid from your customers in pounds sterling, but your supplier's local currency is in euro. So an exchange will need to be made so that you can pay your supplier and receive your parts. This exchange is done by way of transaction in the currency market and would be made through your bank, being in the UK, typically Barclays or HSBC. But this leads you to another issue. In the foreign exchange market, there is a term that is referred to as hedging. A country's currency over a period of weeks or months can fluctuate, which means moving up or down from today's current price significantly. So this can cause huge potential problems in the purchase price of your goods and services. In order to get around this common problem, businesses that do a great deal of international trade enter into a long-term agreement with their bank, which locks them in at a fixed price or a fixed range within a certain period of time. To facilitate this agreement, the banks use a technique called hedging, a process in which they will use complex order book operations to balance the book by using baskets of currency to hedge against any potential direction, one way or the other. A bank will also buy when euros become cheap or move down in direction and sell when euros become expensive or have moved up significantly in price. The distance and quantity purchased is their realised profit on the position. Final aspect of trading is what we do as traders. We are speculating on the particular direction of a currency pair, whether it will rise, fall, based on what we believe the price difference to be from now to that of the future. Whether the future will be in 1 minute, 1 hour, 1 day, 1 week, 1 month, or even a year. So in conclusion, any market is the point of equilibrium between a disagreement on value and an agreement on price. In the examples I have given, the travel money to you is worth more than the exchange service, but you agree on the price. The manufactured value of the car exhaust is worth more to the car manufacturer as it allows them to complete a saleable product, which is then sold on to their customers. Therefore, they value this integral part significantly more than the parts supplier, but they have an agreement on the price. When hedging, fixing the price of an asset with the bank is invaluable to an international business, but the information in which the bank receive in return is what gives them an inside look into what is going on in the market. Take the recent example of Brexit. No doubt the banks already know what the direction of the sterling will be, based on the fact that they know whether trade is drying up or not. Based on the amount of currency being exchanged in comparison to last year, they and only they know the true turnover of a currency worldwide.